Hi guys, my name is Makuju and welcome back to another tutorial where we are going to look at various metrics that investors use to value and assess companies. Okay, and we are going to build on the previous tutorials that we have covered. If you haven't watched my tutorials, please take some time to visit them and you will learn a lot, and then you can understand what we are talking about here. Okay, so let's first of all start by looking at the PE ratio. I think we've looked at PE ratio, we've looked at how to calculate the price earnings ratio, but let's just look at this, because I would like to understand that there could be someone out there who doesn't know what the PE ratio mean, and what a high PE ratio mean to him, or what a low PE ratio means. Okay, so let me just take this opportunity to demystify, okay, about the PE ratio. So the PE ratio, like I said in the previous sections, that it shows how much investors are willing to pay per company's dollar of earnings. Okay, and sometimes when you compute the ratio, you need to know how to interpret the ratio. Okay, so what does a high PE ratio mean? Okay, right. So a higher PE ratio may indicate that the company is overvalued. Okay, which means the intrinsic value of that company, right, may not be as what the market perceives. Okay, it may actually be below what the market is valuing the stock. Okay, that's what the overvalued mean here, because what happens normally, let me just demystify the overvalue and undervalue for now. Okay, so there's an intrinsic value here. Okay, and this is the purpose of company analysis and company valuation. We need to find the intrinsic value. When you do company valuation, you don't necessarily need to come up with the exact match of the share price, okay, or the intrinsic value. But now the intrinsic value, this is the true value of the company's stock. Okay, so we have got the intrinsic value in the market value. Okay, so sometimes when the market value is below the intrinsic value, you need to know this. Okay, so we are saying, let's say the stock price, it's just an example. Okay, the stock price, we are saying the stock price is, let's say it's less than the intrinsic value. Okay, just need to write this. Okay, I think I can't write it properly. Okay, that's cool. And then here we've got the intrinsic value as well. The intrinsic value is greater than the stock price. Right, so at the end of the day, okay, let me just highlight this. Right, perfect. So I need to format this to match this. Right, so let me choose the font here, and let me choose this, and perfect. Right, to match this now. Cool. Right, let me just draw this a bit here, because we need to understand this. Okay, so there's the intrinsic value, which is the true value of the common stock, and the market value, that this is the value that the market adds to the common stock, or what the market perceives about the common stock. Okay, right, then we have got cases, and then here I think I need to specify this. So okay, so let's say we have got terms overvalue and undervalue. Okay, overvalued and undervalued. Okay, so let's say you've done your DCF and you found that the intrinsic value is less than the stock price. So this leads to overvaluation. So it means the stock price is overvalued. Overvalued. Okay. And then, so what does it mean if it is overvalued? It means this is the it offers you the opportunity to sell. Okay. Let's say you found that the intrinsic value is greater than the stock price. Okay. So what does this mean? It means that the stock is undervalued, and it gives you the opportunity to buy. So let me just specify here. There is opportunity to buy stock, to buy the stock. Perfect. If it is overvalued, then sell stock based on your okay. So I think we've understood now. We understand this. There's the intrinsic value. So if the intrinsic value is less than the stock price, then it means the stock price is overvalued. If the intrinsic value is greater than the stock price, then it means the stock price is undervalued, so you can buy. That's what I wanted you to understand, because these terms, they confuse people a lot: overvalued and undervalued. So the intrinsic value, it's your analysis, the value that you get. Okay, let's say for example, when we calculate the PE ratio, okay, let's go back here. Let's say in the normal cases, let's say it was a positive figure, right? 0.54, and here we've got negative 5, 6 something. See, it's all the same, because this will be 54, right? Because if we multiply this, let me try it here. So if we try to multiply this by 100, okay, see, it's 54.36. It's 56.30. Okay, so these numbers, they tell you, let's say you found these figures, between two financial periods. You have to be able to interpret that. Okay, and even when you compare that PE ratio with other similar companies, you also need to know what it means. You see, so here we are saying a higher PE may indicate that the company is overvalued. Okay, then higher PE may indicate that investors are optimistic that future earnings will be high. And high PE may also indicate that a stock price is high relative to earnings. Okay. And what does a low PE ratio mean? Low PE ratio may indicate that the company is undervalued. Okay. And it may also indicate that the stock's price is low compared to earnings, and that the company may be losing money. Okay, so you need to understand all this. Okay, and in our case, we found out that we got negative PE ratios. Okay, what does that mean? Right? Negative PE ratio is a result of negative profits in an accounting period. And for sure, if we check on our extract income statement, we see the profit here. It's not the profit, it's loss. We had a net loss. Okay, so negative PE ratio is common in technology companies. As we can see, Econet is a technology company, and negative PE ratio may indicate that investors are forward looking and hope that the company may be profitable in future. And here's a hint for you. Okay, let me just here's a hint for you. You should worry when the company has been making losses 5 years in a row. Then that's when you should worry. Okay, let's say you have invested in a company, that company has been making losses consistently for 5 years, then you need to worry. Okay. So consistently negative PE ratios may lead to the risk of bankruptcy or insolvency, but that's not always the case. Okay, that's not the case with Econet. Okay, so the negative profits is partly due to the effect of COVID-19. Okay, business was low, and then growth investors mostly use PE ratio to value companies. Okay, so value investors, yes, they use the PE ratio, but the investors who use this ratio widely are growth investors. Why? Because they want to see growth of earnings. They want to grow their investments over the long term. Okay. Now let's look at the earnings per share, right? So the earnings per share, it shows how much money a company makes for each share of its stock owned, and it's a metric that is used by investors to measure the profit of a company, to check whether a company is profitable, right? So what does a high earnings per share mean? High earnings per share may indicate that the company is profitable, right? And high earnings per share may indicate great corporate value, right? So you need to know that when you look at a company's financial statements and you calculate the earnings per share, you compare the earnings per share across the multiple periods, that maybe across 5 years, then that this is a great indicator to help you know if the company is profitable, right? What does low earnings per share mean? Low earnings per share may indicate that the company is less profitable, right? Negative EPS mean that the company has negative accounting profits, like what we witnessed in our example. Okay, so what's the bottom line? The bottom line is the EPS is mostly used to compare the profitability of companies that fall in the same industry. Okay, perfect. Now let's look at the price to book ratio, right? So the price to book ratio is used to compare a firm's market capitalization to its book value. Okay, and is also used together with ROE, that is return on equity, and we can find return on equity using the formula net income divided by the average common stock, right? So the return on equity, when we use the DuPont analysis, we can see, and we can even it's instrumental when we use it to calculate growth, because when we are doing DCF, we need to calculate the growth rate. So we can say retention rate times return on equity to get the growth rate. Okay, so yeah, so it's also used by growth investors to value companies and to identify potential investments. And the book value, I know some of you may be confused now. What is the book value? Okay, the book value is simply the total fixed assets. Okay, so it's tangible net asset value minus intangible assets and liabilities. Or in another instance, the price to book ratio is the same as the price to equity ratio, right? That is market capitalization divided by equity ratio. I think we've covered this. Okay, what does a high price to book ratio mean? A high price to book ratio may indicate that the stock is overvalued. I think I've demystified the concept of intrinsic value and overvaluation. Okay, here's the hint. A combination of high price to book value and low return on equity may show that the stock is overvalued. Okay, and low price to book ratio, what does it mean? The low price to book ratio may indicate that the stock is undervalued. And here is a hint as well. If a company's return on equity is growing, its price to book ratio should also be growing. What is the rule of thumb? Price to book ratios below 1 are typically considered solid investments. Right. So now we've got another metric that we looked at, the price to revenue ratio. So the price to revenue ratio is used to value companies that are not profitable. right? Like I said, it's a company that is just been listed on the stock exchange, and it is in its initial phase, and it has got negative cash flows, negative profits. So how do you value that company? You value the company using the price to revenue ratio. Okay, so price to revenue is just market capitalization divided by revenue, like I showed you. Okay, so let's just look finally at issued shares. I think we've covered this, but let's just it was just a recap this tutorial. So issued shares or outstanding shares are the actual shares issued or sold to investors from the available number of authorized shares. Authorized shares are the maximum number of shares a company is allowed to issue to investors. Okay, so guys, I think now you've an idea of what this is all about. Okay, and here this is not investment advice. Okay, I just have to put this disclaimer. This is not investment advice. It's just me helping you understand some of how these metrics are used and what they mean. Okay, so don't take my word for it. Just go out there, do your own research, do your due diligence, do your research, right? And that's how you become a better investor. Okay, you need to learn to do your own research. Don't rely on other people on what they tell you. Okay, because normally when people are giving analysis of companies or stocks, they are biased depending on, because sometimes let's say when a person gives an analysis of a stock that he is invested in, then he's likely to be more biased. Okay, so you need to learn to do your own research. So thank you guys for watching, and I humbly request you to click the subscribe button, like, comment, and share these tutorials with your friends. Help them get to know this information. It's very important. This will change your life. Okay, so I thank you so much guys, and God bless you.